Good morning, good afternoon, good evening, wherever you are in the world. This is the ECOMFIN webinar series at ESSEC Business School, and I am Andrea Roncoroni, Director of the Center. So today we welcome Professor René Caldentey. René is Professor of Operations Management at the University of Chicago Booth School of Business. He received the Master of Arts in Civil Industrial Engineering from the University of Chile and a Doctor of Philosophy in Operations Management from MIT. His primary research interests include the stochastic modeling with applications to revenue and retail management, queuing theory, and finance. René has been published in top-tier academic journals, including Advances in Applied Probability, Econometrica, Management Science, Mathematics of Operations Research, Manufacturing and Systems Operations Management, Operations Research, and Queuing Systems. He has served on the editorial board of several journals, including Management Science, AMSOM, Operations Research, Productions and Operations Management, and the Journal of Systems Engineering. Thanks for joining us, René. You're presenting a paper on financial hedging of operational risk. The stage is yours.
Thank you very much, Andrea, for inviting me to this seminar series. I was actually looking at the website. You have a very nice list of speakers, so I'm very flattered that you invited me to join. Thank you everyone for coming. So indeed, I'm going to talk about this paper. I have to be honest, I was talking to Andrea before we started the seminar, and I have been somehow a little bit away of this area of research for some time, so I might come across a little bit rusty, so I apologize for that. And so this is a paper that was somehow we put on pause with my co-author, and we recently came back to it, and we are kind of submitting it for publication, and we are in some rounds of revision. So any comments that you might have will be obviously very welcome, because we have time to incorporate some feedback that I can get from you. All right, so anyway, feel free to stop me at any point if you have any questions, comments, suggestions, and so on. So let me start with a little bit of motivation. So as you will see, we're trying to, in this paper with Leon, we're trying to develop some sort of a mathematical framework to study the classes of problems that I have been looking in the past in this space, which is how to somehow integrate some financial instruments, financial hedging, in the way we operate a non-financial corporation. So that's the idea. So trying to focus on non-financial firms here and try to see how the decisions that these companies are making should be influenced by the possibility of these companies to maybe use some type of financial hedging to manage some of the risks that they might face, right? And part of the things that we're trying to do is to use these financial markets as a way to potentially value the operating cash flows that the firm is producing. So somehow have some sort of a quote unquote objective way to measure the value of the cash flows that these corporations are generating, and also to mitigate, as I said, the risk that they might be facing. Okay. So this is very general. Now, for this particular paper that I'm going to be discussing, what is the kind of desiderata that we're trying to implement in the framework is we would like to be able to potentially acknowledge the fact that large corporations, there might be different stakeholders, and they might have different risk preferences. And in somehow in the origins of this paper, we were actually discussing some sort of a principal agent type of framework. So I want to throw that, although that might not come up very clear throughout the presentation itself, but the origins of this research were somehow thinking about, some sort of a principal agent type of framework where you have on one end a set of agents that might be the shareholders of the companies that would like the firms to do certain things, and on the other hand, we have managers who are in charge of executing some of these mandates, and they might have a different set of preferences, and that potentially creates agency-related costs in the way you operate these corporations. So we're trying to think about that, and so you will see eventually how the framework that I'm proposing is trying to capture that aspect of this type of operations. Of course, we want the financial markets to be able to hedge some of the risk. As I said, used for valuation purposes and also for informational purposes. So this is something that goes back to the kind of early stages of my work on this space, which I think it makes sense to anyone, but I would like to explicitly acknowledge the fact that even if you are not able necessarily to do any hedging with the financial market, they provide information, valuable information that potentially can be used in the way you manage your operations. And so there's this informational aspect that I think is very important, and I would like to talk more about it as well. And finally, we're operating in an environment where we have a non-financial corporation, so there's some incompleteness that is naturally inherent in the environment, in the cash flows. And so obviously we want the framework to be able to capture this. So these are kind of the ingredients, if you want, of the framework that we're trying to develop. And so you will see how these different ingredients come into play in the proposed model that I'm going to be discussing in a minute. Now, maybe I don't need to go into the slides with you guys, but just very quickly, so the idea here is that we have some sort of a finite time horizon, and then we have a corporation that is making some sort of decisions, and this could be dynamic decisions about how to run their operations, could be inventory decisions, supply chain management decisions, production decisions, quality control decisions, anything that this corporation is actually engaging in on a daily basis. And we're going to call that simply gamma, right? So gamma here, when every time that you see some gamma in my slides, you should think about there's an operational decision that are being made, right? And this will eventually lead to some operational cash flows that we're going to somehow collect at the end of this planning, all right? So let me call that H of gamma. Omega here was just to acknowledge the fact that these are random stochastic cash flows, right? And so what we would like to do is to take this problem that this firm is trying to manage, which is how to maximize this operational cash flows by controlling this operation, and add the fact that we can in parallel make financial decisions. I'm going to call theta kind of my financial decisions. And these financial decisions, what I'm going to be making in the context of my model is producing a financial cash flow that I'm going to call a G of theta, right? And so we're going to take these two together, we're going to add them, and we're going to say that the firm is somehow trying to control operational decisions and financial decisions, and is producing this operation and financial cash flows H plus G in this slides. All right. Now, the goal would be to say, okay, how we integrate our operational financial decisions? Well, let me try to maximize some utility, right? So let me put some preference in terms of these cash flows and the underlying stochasticity. And so let me use some sort of maybe utility, right? So this is the way I initially I thought about this problem, and we kind of study this in a couple of papers that I have with a cohort of mine, Martin Hall. And so we were trying to say, okay, let's look at what's the optimal gamma, what's the optimal theta, so that we maximize this expected utility, right, of this terminal cash flows, all right? So the very kind of utility-based, as I said here, approach to thinking about the integration between operations and financial decisions. But as we were working on this kind of problems, we noticed something which is kind of motivates some of the things that I'm going to be presenting to you today. So let me kind of give you an example of what I mean by this. So take a very simple example. Take a news vendor problem. So the idea of a news vendor is that you have a point in time where you have to make some inventory decisions, and you're going to make those decisions to serve a future demand that you're going to observe at the future time, capital T, let's say, and that demand is some sort of a random demand, right? And so the typical news vendor problem is to say, okay, what should be the inventory that I need to select so that it maximizes my profits, and the profits will, to some extent, depends on the selling price, on the procurement costs, maybe there's some salvage value attached to these units, and then there might be some penalties if you run out of inventory by the time you're selling, right? So this is a very standard formulation. So my cash flows for this news vendor will be given by this expression that I'm showing you here as a function of these inputs, all right? And so you can say, okay, suppose that we have these operational cash flows, and then we try to understand how those cash flows might be potentially connected to some economic index, which I'm calling here X, all right? And so for the purpose of this illustration, let's suppose that when I look a bit more carefully at my demand as a stochastic object, I see that this demand depends in part on the value of this index, and might depend on part on some idiosyncratic noise, some idiosyncratic component that is purely operational. So the idea here is that, the financial market, the financial index to some extent is telling me something about demand, And there's a paper by Vishal Gore and Suraj Chaudhary where they actually look at these kind of problems, and they actually look at data where they connect the demand of retailers to the S&P 500, for instance, right? So that will be the index that they use, and there's a correlation between those two, right? So the fact that there's a correlation, of course, means that there's an opportunity to hedge some of the risks that you have, and so you can engage in these financial risks of managing the cash flow of this news vendor. Now, suppose that you take that problem with this structure and you use a particular utility. Here, I'm using a quadratic utility. So you say I'm trying to maximize the expected utility, but in this particular case, a quadratic one. So what I'm showing you in this table is how the optimal inventory decision, so the optimal I that you should decide, changes as a function of the market price of risk, so mu over sigma for the index, and then different type of financial strategies. So the first column is no hedging at all. So you just use the plain vanilla news vendor solution for this problem. Then here you have a static, like buy and hold type of strategy. You just take a static position in the financial market, and then you try to hedge your risk that way. There's something here about incomplete strategy, and incomplete, you will see in a minute, means that the way I'm going to do my hedging is by only tracking the evolution of X during this time frame that I have here, but I have no way to observe this component here. So this might be completely unobservable to me when I do my hedging. And then the final will be a complete hedging strategy, which again means that in the process of doing my trading, I'm actually observing both the evolution of the index and as well the evolution of this stochastic process here. So I have kind of full visibility of the noise, how it's evolving over time, and I can try to use that. And so as you can see, what happened is that, well, there's obviously some effects on the inventory. And in particular, what I want to highlight is that as we move into this more complete information structure, and as I look down this table, I'm looking at situations where the amount of inventory that I'm actually managing is very, very small compared to what would be the inventory that I would like in a completely operational setting, right? So I suppose if you start thinking about this table for a second, you will realize that the answer to this might be relatively obvious, right? If my goal as a firm is to maximize my utility, which is the sum of the operational and financial gains, and I move it into a region where I have a relatively very, profitable financial markets, then essentially what this is saying is that I should close my operation and I should become a financial. So there's no need for me to sell anything. So it's a little bit unsatisfying, right? Because I mean, what this is somehow saying is that when you treat operational and financial cash flows the same, and I just add them together to somehow optimize the expected utility, I'm somehow treating both sources of cash flows equally in terms of the impact on my utility. And therefore, it might be possible that in some situations, my operation becomes, kind of very uninteresting, right? So of course, this speaks for maybe this news vendor shouldn't be operating in this business, right? So you can take this table and say, okay, maybe the news vendor business is not very profitable, and this is what is happening here. But to some extent, what I mean, my sense is that we would like to bring some of these ideas of how to use financial market to support operations, not just to end up suggesting that we should close the operation altogether, right? Yes, Andrea, please.
Yeah, thank you, Renee. So I have a question. So I perfectly understand what you say, and I all agree with it. And I was saying, if the demand is partly driven by some financial index, it might be the case, think about a commodity, that the price, which here is taken as a constant, is related to X as well. Now, assume that this is the case, and we have P to be connected to this financial index X, and possibly, maybe why not, to the demand, like in a price demand model. So, but let's keep this second assumption aside. So for the moment, let's say P depends on X. Now, the risk premium actually enters the operating revenue through P as well. So in that case, might there be, in your opinion, a trade-off between these two channels where the market premium enter the final payout? One channel is the hedging, And the second channel is the operating revenue through P.
Right, absolutely. So yeah, I agree. So it's not necessarily what I'm trying to say here is always going to be the case, right? So there might be, as you point, situations where maybe through, I mean, if you think about this news vendor as an asset category that is kind of somehow correlated with the financial market, you would expect that maybe the return of this asset category might also go up as the financial market goes in certain directions, right? So that's obviously a possibility. But I suppose that there might be situations where that channel might not be present. And if you were to take this type of result that I'm showing you here in the table, what this result was suggesting is that you should essentially close your factory and move on. And again, as I said, this might be a sign that this factory as an asset category is not very profitable. Maybe you shouldn't engage in manufacturing widgets with that facility because it's not a very profitable business. And this is what this table is suggesting. But at the same time, I would say that, you know, we might not necessarily want to go in that direction, right? So at least to me, I felt that as an operations person, I was trying to think about using financial market to support the operation, not to close the operation. Let me put it this way, right? And so as I was working with this type of formulation, I thought about, okay, well, I mean, what might be happening here is that I'm treating these two sources, these two cash flows, as I said, equally from the point of view of the utility that I'm trying to maximize. Maybe I don't want to do that. Maybe I want to treat them differently, right? And so what I'm going to be presenting is an alternative way to think about these classes of problems where I try to treat effectively these two differently. And you will see what I mean by that in a second. All right. But this was some sort of a motivation for this work as I was working on this utility-based formulation that I showed you before. All right, so let me go with what I would like to talk. I mean, this is kind of a quick outline. There's three examples that I'm going to discuss that we talk in the paper. Maybe I don't know if I'm going to go in full detail. These are more like for illustration purposes than anything else. So I might maybe go quickly on some of the examples just to show you some plots, but maybe not spend too much time on the application themselves, right? I don't think that's the general scope of this paper. All right, there's a fair amount of literature, of course, and there's literature that's important in terms of the methodology that we use, and we're going to use essentially hedging and incomplete market type of literature to support some of the models that we develop. There's, of course, a literature on real option. I'm not putting any papers there that connects to the idea of how we use financial market for cash flow valuations, and you know, there's a very healthy history on that front that connects to the type of idea that we're presenting. And of course, and this is where I'm very rusty. I know that some of the papers I'm putting here are kind of old, and I'm sure there's more literature in these days that I haven't really explored in detail. So I apologize if I'm missing things here that should go. And if you have any reference that you think I should add to, feel free to send me an email. That would be great for my literature review. All right, but there's people in the ops trying to understand how to use operational hedging and financial hedging for the purpose of managing risk preferences and risks. All right, so let me go straight to the model that I would like to propose. So the way that I would like to think about this problem is by somehow separating what I would consider my objective in terms of an operation and the way I want to handle the risks attached to the management of the operation. And I want to bring that risk into the constraint of my formulation, and I would keep on the objective what I would consider is the maximization of the value of my cash flows. All right. And so the way I'm going to think about this is by assuming that my objective is to find a pair of strategies, again, gamma for the operation, theta for the financial strategies that I'm going to engage with, that maximize and Q here, think of Q as an equilibrium martingale measure that I'm using. So I want to maximize some sort of the value of the cash flow that I'm going to produce from a market standpoint. But then I want to acknowledge the fact that, you know, there's people taking decisions, and these people are risk averse. And the way they see the different alternatives in terms of will come with some risk attached, and therefore they would like to put some risk measure. So think of R, some form of a risk measure that they would like to use to actually somehow bound the amount of risk that they want to take in the way they approach this problem. And then on top, we have kind of financial constraint that we need to impose, obviously, on the strategy that I'm using. And there might be informational constraint that I need to impose in terms of how I control what is the information that is available by the time I'm deciding whether my operational and financial decision that I make. I'm going to talk a bit more about this in a minute. All right. But essentially, I'm separating this. And so this is where I have a little bit that principal agent type of formulation, right? So in some sense, I'm using the Q measure here because I'm thinking that maybe this is from the perspective of the shareholders and they want to maximize the economic value, the market value of these cash flows. But then there's managers who are making these decisions and they might not be necessarily in the same, they might not have the same preference, they might have not the same ability to somehow manage risks in the way that shareholders might do, right? And therefore, by the time they're deciding what operation decision they want to make, they want to some extent impose some risk limits into what they would like to do, right? So the manager will be fired if they take too much risk, but maybe the shareholders want them to take that risk. Yes, there's a question, sorry.
Yes, can I ask something? I mean, it
Yep.
sounds, I was listening to the original formulation, and it seemed to me like it didn't make sense. Are you a financial company or an operational company? And
Yeah,
I think,
okay.
and think what you are getting at is
Yeah.
you're saying you are an operational company, operations company, but
Yeah.
you are going to hedge some of your risks with financial instruments.
That's right.
So this is what you are getting at from this.
That's right.
Right,
Well,
okay.
yeah,
Okay.
right.
Because now
And
this makes perfect sense. Otherwise, it
yeah.
might very well be possible that none of the operational companies should exist, just go in the financial market. I mean, the farmer.
That's precisely the point. The point that I was trying to make before is that if you take a particular way to think about this and you just combine operation and financial cash flows into some sort of a cumulative flow, and then you try to maximize the expected value of some utility of those cash flows, you might find yourself that you might end up closing your factory. But when you take a formulation like this one, now you're explicitly saying that I want to maximize this. And let me go one more step with this, because I'm going to use some sort of very standard assumptions in terms of the financial market. I'm going to assume that financial markets themselves are complete, and I'm going to restrict to self-financing trading strategy, which essentially means, to some extent, without necessarily loss of generality, that means that the expected value of this G with respect to Q is equal to 0. So these are no values. Any financial activity that you produce per se produces no value. And so when you place this expectation here, you will see that this term will cancel out. And so you're going to be left just with the expected value under Q of H of I. So essentially, you're trying to maximize the economic value of the operational cash flows. But then you have risk constraints. And because you have these risk constraints, is that you have an opportunity to use financial markets to hedge the risk of these constraints. All right. So let me see if this is clear, if there's any question on the kind of general framework that I'm proposing here. Otherwise, I will go into some of the details if you have, and maybe other questions will come. So take an example. So as I said, there's a couple of examples we discussed in the paper. One would be the example of some sort of an exporter, right? So suppose that you have a factory in China, you produce some product, you can sell in the local market, but you can also sell it in the US. And then you're going to be exposed to, of course, demand risks, but also exchange risk, right? So you know what's the exchange between the yuan and the dollar, and so you're exposed to that risk as well. And so again, I'm not going to the details of this of the model themselves, just for illustration. But suppose you take this problem that this producer is facing, and you say, okay, suppose that this manufacturer has no access to the financial market or decide not to engage in financial markets whatsoever. Then they might actually find themselves, and so here the two axes will be the inventory or production in the local market and production or inventory level in the foreign market, in the US in this case. They might find themselves that the feasible region of operational strategies, in this case inventory strategy, is restricted to this region here, right? And what would be optimal would be to select this point right here, right? And there's some sort of this line here is some sort of a capacity constraint that they may face, right? We talk about this in the paper. But if you take a position in the financial markets, in this case, a simple buy and hold in the exchange rate, now what's going to happen is that you're going to be able to expand the feasible region of potential productions levels that the firm can take. And then within this feasible region, you're going to be able to pick a point that actually belongs here. So essentially what we're saying is that by having access to financial markets, you're going to be able to expand the set of feasible operational decisions that you have, right? And because you are expanding the set of a feasible region for operational decision, of course, you're going to be maximizing the value of the operating cash flows that you're going to be able to produce with this facility in this case. All right, so that's kind of pictorially, what we're trying to say here is that financial markets are in some sense allowing you to expand the region, the feasible region of we might be considering feasible operational strategies that you have, right? So it's very operational, right? So it's all about the operation and how we expand the feasible region of operational decisions. And that's kind of what the framework is actually helping us to do. All right. Okay, so yes, there's a question by Jaime, yes.
Yes, Rene, nice.
Yeah.
So what would happen if you have, if you choose the first framework where you're maximizing utility, but
Yeah.
you consider these two conditions in the in financial markets, that you have complete markets and
Yep.
you have this self-financing strategy.
Yep.
So in some sense, you're never gonna transform into a financial business, right? And the only
it
role
does. I mean, this table is precisely that.
Okay.
So this is a table that I constructed by, I pick a particular utility function, quadratic, so I can solve certain things, but this is exactly what we're doing here, right? We're just adding these two. This is a, it's the same frameworks. We're using self-financing trading strategies for G here, right?
So the expected value of G is 0, right?
Yes, absolutely.
Okay.
Under Q, right? Under Q, right? But again, it doesn't really matter what measure you use, actually.
Yeah.
Is the point being that as the market price of risk really grow high and high and high, right? You're gonna be taking positions that will actually minimize or reduce quite significantly the amount of inventory that you need in this case. So that was a little bit why I said that this was a little bit dissatisfying, unsatisfactory as a result. But again, going back to Andreas, this is just one example, right? It doesn't have to be all this like this, but it is possible in some situations. And that's why we are coming to kind of this type of framework where we are proposing to remove the risk aspect of the preferences into the constraint and keep on the objective the notion that we're trying to maximize the economic value of the operating cash flows, right? And so in this world, you're never going to close the factory. You close the factory, you get an objective value of 0, basically, right? So there's no point for me to do any of that. I'm only going to use financial market to expand the feasible region, as I show in this picture, of operational strategies, right? So that's the only reason why I go into the financial markets, because I want to have a larger feasible region for my operation strategies. Okay. All right. Now, of course, what kind of constraints we can handle, that that's where devil's in the details. So there's certain classes of risk constraints that we can manage, and so this is the class that we are proposing, and you will see why. But we call them generalized mean variance, in the sense that we're going to look at these risk constraints, and we're going to look at them from kind of some sort of the mean value of your payoffs, think of it as a risk, minus a penalty that depends on the variance. And we're going to add 2 parameters, alpha and beta, that will allow us to control how significant our risk aversion is with respect to that volatility, right? So a couple of examples. For instance, the classical mean variance will fit this framework, of course, because you will pick the alpha to be this parameter here, and a beta will be 1, right? The mean standard deviation will be, again, another one that you can model with this class, where you will pick beta to be 1/2 and alpha to be this particular parameter here, right? Now we can do a bit more. So remember that I mentioned that originally I was thinking about principal agent models, and so I was thinking that maybe the constraint should be some sort of the risk, the utility of the agent, right? So the agent wants to maximize or have a minimum payoff, and so you can generalize this class that I have here to this one that I have here. So here there's another parameter, there's a function really, there's a phi here that you can evaluate in the mean. So again, nothing particularly. I mean, it's a bit more flexibility, but you can take a utility. So you can replace your risk by some sort of a utility, and you can say, if I use a second order approximation of this utility function around some arbitrary number k, then that utility can be expressed like this, where here you have, again, this kind of generalized mean variance type of expression that will replace on this arrow coefficient for the utility function, right? So the ratio of the second derivative to the first derivative. So again, so it's this an approximation, of course, because it's a Taylor expansion, second-order Taylor expansion, but you could start capturing implicitly utility preferences in the constraint and model them using this kind of function that I'm going to be using in my framework. There's another question. Yes.
Can I ask this? You said that beta and the parameter beta is a kind of risk aversion. Is it the risk aversion or is it preference for higher order moments? Why is the risk aversion beta?
In the sense that the way we're going to look at these constraints, we're going to require this risk measure to be greater something. So we're going to say we want this to be greater or equal to something, right? That means feasibility. So I want my, you will see, I want my expected payoff to.
I understand alpha is a measure of risk aversion. Beta, it seems to me, is controlling for some, for the distribution or something.
Well, if the variance of, if the volatility of my cash flows increases, right, the negative effect of that will be exacerbated or attenuated by beta, right? Right?
Okay, yes.
So more volatile cash flows.
Technically, yes, but what is the meaning? Yes. You can just.
Well, the only meaning
say
here.
Yes, but I can also say you use a higher alpha, right?
Right, there is a trade-off. There is a trade-off, but you will see that they play a different role in the overall analysis that we're going to conduct.
So somewhere else in finance, is there a reference on this function?
No, so that's why these are the typical one that people use, right?
Yes, okay, yes.
That's right. And so the only thing that I'm saying is that you can generalize this too by putting an alpha beta here. So they give you 1 degree of freedom, additional degree of freedom, right? So that's really the way I'm thinking about this, is that we have a bit more freedom by putting a beta there, right? But if you want to stick to one of the classical ones, you just pick beta to be 1 or 1/2, basically. Yep. All right. All right, so this is the class. There's one more thing that we can do with this class, which is we can compare this to kind of classical measures that people use more in more financial contexts, right? Like VAR and CVAR. So there's some sort of a relationship between these measures. So here let me go quicker because I'm kind of running out of time. But VAR, CVAR are lower bounded by the mean standard deviation, which will be this particular version of the generalized mean variance that I showed you before. So there is this, there's this kind of bounds, and there's this paper that we just discovered only recently, I have to say, is kind of hidden somewhere in the literature by this guy Hulliman, who studied this kind of two-moment risk measures, and he actually shows that you can pick some distributions of this risk X where you have actually equality here, right? So actually these are tight under certain conditions. But generally speaking, there are inequalities. And now we prove this using some standard machinery going back to the work of Rockefeller and Ursayev on CVAR. So again, I'm not going to go into the details, but we can always connect this class of risk measures that we're proposing to this more classical VAR and CVAR. Anyway, so the whole point is that we are being restrictive, but we have a class of risk measures that potentially can be flexible, right? And to accommodate different type of preference that we might have. Now, in terms of the financial markets, we're going to use something relatively standard. We're going to take two Brownian motions, and then we're going to define some sort of a risky asset or index that we're going to be observing that evolves according to this dynamic. So B1 here will be the Brownian motion that drives the stochasticity of this stochastic index. We're going to have a filtration that is a filtration that depends on both sources of noise. So the way we think about B2 is the kind of orthogonal idiosyncratic noise that is purely based on the operation cash flows and how they impact, not necessarily correlated to, so these two are independent. Now there's a filtration that is only the one that you can track by observing the value of X, all right? And of course, we want, in general, the operating profits to be a function of both of them, right? So these adapt to the joint filtration generated by both B1 and B2, right? Now, the fact that the financial market is complete, again, I shouldn't maybe emphasize this to this audience, it's just that if you give me any cash flow, any risk, any random variable, if you want, that is adapted to the FTX, you can actually represent that, right? So there's a representation of that through the stochastic integral, and so this will be kind of your replicating strategy that you will use. And we're going to assume that there's also a unique price density for pricing claims that are only dependent on X. And so this pi here will be this state break density. So the expected value of the Q can be written as the expected value of pi H, right? And so pi can be expressed again through this market price of risk ratio that I'm showing you here. All right, so this is fairly standard, I would say. Now, informationally speaking, what the firm knows is, of course, the firm can observe and track the financial market, so at least knows this, but it's not obvious that observe the entire operational noise, and so that filtration is still somehow living in between these two. We only study the two extreme cases, when this is an equality or when this is an equality, right? So these are what I call the incomplete information, which is here's an equality, and the complete information is when here you have an equality, right? But you can imagine that there might be intermediate cases that one could potentially study. All right, so when you take the problem that I formulated and I put my generalized mean variance, this is how the problem looks like now. So this is a problem that I'm trying to optimize to figure out what is the optimal solutions for the operation and financial decisions. And we're going to solve this in a two-step approach. So the first step is that we're going to fix the operational strategy, right? So let's fix it. And if I fix this, you can see that because my objective only depends on the operating cash flows, the only thing that I need to worry is that I want to maximize this kind of left-hand side of the risk constraint, right? And so essentially this goes back to the idea that I want to maximize the feasible region, right? That I was showing you in that picture. And so you can formulate this problem, which is I want to, as a purely financial problem, if you want, where I want to maximize the value of this generalized mean variance constraint, subject, of course, to the fact that my I have a set financial strategies and that my financial strategy has to be adapted to the information that I have. And now by relaxing these constraints, so remember we can rewrite this in terms of the market price of risk. So I can actually reformulate this as a quadratic optimization problem. So we're going to exploit that. And by the time we solve this problem, then we can put it back into the original formulation, and I will be solving what I will call here is a purely operational problem, which is to find what is the optimal operation strategy subject to some sort of relaxed constraint that I have generated by solving the first one, right? So this somehow give me two problems to solve. One, which is purely about finding the optimal financial strategy, and then what is the optimal operation strategy. So this is how we go about this. Okay, makes sense? All right, so so as I said, the problem can be, and this is where my generalized mean variance plays a crucial role, right? That's why I picked these classes of risk constraints, because I can solve a quadratic quadratic hedging problem with incomplete. And so we know how to do this. So if you have complete information, it's very straightforward. You just relax this constraint, and then you use conditional expectation to impose the measurability condition that you have, and then you solve for the Lagrangian multiplier, and then you have a very straightforward way to solve this problem as a function of the state break density. So this is very standard. It's a kind of very classical way to think about this. People will call this the martingale method to solve these classes of problems. Now, if you have complete information, it's a bit harder, because now you need to optimize over this family of financial gains. And so this is a bit more involved. You cannot do the same trick. And so what you can use, again, the fact that you have this quadratic problem, is that you can view this as some sort of a, you can use the machinery of a Hilbert space. So you can think about this as a orthogonal projection in a Hilbert space that you're really solving. You're trying to project into this linear subspace. And so that means that the optimality conditions, really you're looking for a hedging strategy in this space, G star, that is orthogonal to any other one, right, in this subspace. So this is kind of the orthogonality property. And so you're really solving for this. And the way you do it is by actually constructing a tracking process, Z of t, so that you want to be orthogonal throughout the entire time horizon. Of course, the terminal value of this tracking process has to be equal to the claim that you are somehow having an operational claim here, H, that you have. All right. And so you solve that. That's a difficult problem in general. But if you restrict yourself to this extra condition, and again, I'm not claiming that I came up with this machinery. Is really work by Schweizer and Vollmer really that developed this machinery. But if you have a deterministic market price of risk, then you can construct what they call is a minimal equivalent mathematical measure that will solve kind of that tracking problems. And so it's essentially computing this condition expectation that you have here, and then representing this kind of with respect to x and with respect to b, right? So you essentially you have stochastic integral or a martingale term that is really coming from the projection of that claim into the financial market space, and then you have whatever is left, which is the orthogonal component, which is purely operational, and then you can use this decomposition to construct your trading gain by solving this stochastic SDEs that you have here, where this function g is somehow coming from this. So this is not an easy problem. I mean, mathematically you can formulate this, and so you have a concrete way to compute these trading gains, but it could be a very hard problem to solve in practice, right? So you know, well, this is what comes with this type of dynamic hedging in complete markets, is that they can be very very tricky to solve. I mean, of course, numerically you can try to solve this, but analytical solutions are limited typically. All right, so now that we know how to use that machinery, we can go back to the problem that I presented you before. And so the first thing that you will do, you will take your operation claim and you will project it into the financial markets. So you will take condition expectation with respect to FTX. And so this difference is kind of the orthogonal component. You will look at the variance of that. And this is really the one that you want to hedge for the point of view of your risk measure. And so there's three cases. And this is where the parameter beta and alpha that were discussed before come into play. If beta is sufficiently large, greater than 1/2, or if beta is equal to 1/2, but alpha is greater than this, and remember the state price density here, then your problem, you can optimize your risk constraint. And essentially, you need to solve this equation here. You need to look for the root of this expression here. And now you can rewrite your operation problem in this form, right? So now you have a problem that is purely operational because you have somehow embedded in this constraint here the optimal solution of the hedging problem. If beta is equal to 1/2, so and alpha is equal to this expression here. So this is very an edge problem, very kind of the boundary of these two cases 1 and 3 that I'm going to show you. Then essentially your operation problem is to this. Essentially, you want to maximize the economic value of the operating cash flows. Subject to that, the expected value of those cash flows has to be greater than your threshold that defined your risk constraint. So it's kind of a very, very simple version of this. And now when beta is less than 1/2, or if beta is equal to 1/2, but alpha is less than this expression here, then essentially you can remove completely the risk constraint. Now your problem is really about maximizing the economic value of your operating cash flows. The risk constraints completely disappear. Now, this is the case going back to my parameters. That's why I think having this parameterized version of my constraint gives some insights, is that when beta is less than 1/2, essentially you're saying that the variance is penalized in terms of its value by a factor, a power that is less than 1/2. So it's less than this standard deviation, if you want, if you were to think in simple terms. And so that means that you can always find a hedging strategy that will remove completely your risk constraints. Okay. So this is kind of a potentially an interesting takeaway from this, right? And so if you're not too risk constrained, you can always kind of wash away that risk constraint by trading. Now, in the case where you have a mean standard deviation, which will be this case, the condition alpha less than this kind of threshold in terms of the state price density that you will need in order to remove the constraint is equivalent to this. And so again, this 8 is always between 0 and 1, so you will need a condition on the market price of risk. So in other words, what this condition is saying is that when the risk preferences between P and Q, when P and Q are sufficiently different, let me put it this way, then you might be able to achieve this condition. So in other words, to remove the risk constraint completely in this particular case is only possible if there is a sufficient difference between the preferences of the managers, let's say, and the market valuation of cash flows. When those two things are very different, then you can remove the risk completely in this particular case. Now, if they're equal, for instance, if P is equal to Q, then you know that obviously the expected value of the state product density is actually equal to 1. And so you will never be able to satisfy this constraint. All right. So when P is equal to Q, when these two measures are always at the same, then you cannot remove the risk constraint. Right. So that's another takeaway. And the other potential takeaway is that if you look at this, the value of this, the expected value of the state product density, is actually equal to this expression here, which is essentially the expansion of the integral of this market price of risk. And so if this is obviously it's always, if this is non-zero, small but non-zero, then if T is sufficiently large, this is going to grow and unboundedly, which means that you're going to be able to meet this condition eventually. So in other words, if the time horizon is sufficiently long, so if you give me enough time to hedge somehow, I will be able to remove eventually the risk constraint altogether in this setting, right? Now, of course, this raises the question of what's the proper time frame. But if you think about this as some sort of a principal agent problem, and I'm actually trying to evaluate performance over a certain time frame, what this will suggest is that if you give enough time to this operation to run before you evaluate the cash flows, then you're going to give enough time to managers to hedge away their risk preferences and be able to achieve what would be the operation strategy that maximizes the cash flow, the economic value of the operating cash flows, right? Which is what you're trying to maximize. All right, so a couple of pictures before we finish. So this will be kind of the picture that you will have. Say there's this news vendor. So this will be my objective value, the expected value of the operating cash flows under Q. Maybe this is my risk constraint. So you see that I would like to be here where I maximize my value. But if this is my constraint with no hedging, the only feasible region will be this, right? Where this green line is above my threshold. And so my optimal constraint solution will be here, right? So there's an inefficiency because of the fact that I have this risk constraint. But if I add in this example the option to hedge and trade, then my constraints actually lift this value, and now I can actually implement the optimal unconstrained solution, right? So this is a situation where I have been able to remove completely. The constraints are still there, but I can actually achieve the first best unconstrained solution just by trading, right? So this would be the kind of what I mentioned before. I'm expanding the feasible region of optimal strategies, and therefore I can improve on my objective. This will be a situation where I look at, remember that eta, which is a measure of risks. So the larger the value of eta, the closer to 1, the more risky is this manager. And so with no hedging, my solution, this is the ratio of the unconstrained to the constrained solution. Of course, if eta is very small, there's very little risk. Risk preferences are very lax, and therefore you can achieve the first best. But as eta increases with no hedging, your solution goes to 0. Essentially, you are completely infeasible. And then if you have the ability to hedge and you have complete and incomplete information, you can see that you can go longer. Eventually, if your risks are so high, then eventually any model will become infeasible from an operation, right? But you can see that you can expand the region of even optimality by having ability to hedge. And this is what I was saying before, if you have time. So you can see here, if you increase the amount of time with no hedging, you're essentially adding more risk to and therefore very quickly you become infeasible, the blue line. If you have incomplete, you are optimal for some time. Eventually you become infeasible because there's too much risk that you cannot hedge with incomplete hedging. But again, if you keep giving enough time, eventually you become feasible again. And if you have complete information, then you are always feasible. And then eventually you become, again, asymptotically optimal as you give more and more time. So these are the kind of sensitivity analysis that you can do of the model as a function of T, kind of connecting what I was saying before. Anyway, so we have this risk-averse exporter. We do the same thing we studied the problem under incomplete, complete, and no hedging. We studied the solution, and we have similar type of graphs that I was showing that essentially describe how the feasible region of optimal strategies increases and how you might move from potentially infeasible to feasible, right? As you add more information in the way you're hedging. Anyway, so these are just illustrations, right? As I said, the paper is not necessarily about one of these applications, more about the framework and what we're trying to achieve by moving the risk preference into the constraints. All right, so let me just finish with this. So what I have tried to do in this presentation is to show you some sort of a way to think about this type of class of problem. We're trying to integrate operational decisions and financial decisions. And the framework that I'm proposing here is one that is trying to really put at the center the idea that I would like to maximize the economic value of the operating cash flows that the firm's been producing and only use kind of the financial markets to hedge the risk. And the way we think about that risk is through the constraints that managers of this corporation might impose on the different operation strategies. And therefore, by adding the ability to hedge that risk, what we're essentially doing is expanding the set of feasible operating strategies that can be used, right? And therefore, because of that, we're going to be able to maximize the economic value of the cash flows naturally. And so the framework uses two measures, P and Q, and part of that is to capture maybe the different preferences of the mismatch in preference between maybe shareholders that want to really maximize the economic value of the cash flows and managers that have these risk constraints. And we also talk about different information structures, and you saw some of those plots, how the different information structure will potentially have a significant effect on the feasibility or infeasibility of some of these problems in some cases. One of the takeaways is that, again, if you have some conditions on the risk preference, you can completely eliminate the risk constraints altogether, as if they were not there, right? Kind of in the spirit of maybe a Modigliani-Miller type of result, where you don't have to worry about risk preferences, right? Just maximize the economic value of the cash flows. Other people will take care of the risk, right? So your duty as a manager is to just maximize the economic value. So you can achieve that even in this framework. You have constraint imposed, but the risk preference have to be in a certain domain for this to be true. And in terms of future research, well, I mean, obviously I show you this generalized mean variance constraint, and I try to explain why we pick them, because they lead to this kind of quadratic hedging problems that we know how to solve. But maybe you would like to think about other type of risk measures that could potentially be studied. For instance, I know that if you were to use instead of a risk measure, an exponential utility function of the kata type with constant risk aversion, you can actually derive similar type of results. Of course, you wouldn't be doing quadratic hedging, but you will be able to actually solve the risk constraint problem for that type of family. So I have explored that, and I know that this is possible. But these are special cases. The question here would be: is it possible to maybe think a bit more broad about what kind of risk constraints can be handled, and will lead to some sort of a practical way to think about these issues? Anyway, so I will leave it at that, and I believe we have 1 minute. Sorry, maybe I ran out of time in case people have questions. All right, well, there's no questions. So thank you again, Andrea, very much for inviting me and for your patience. And so I appreciate the opportunity.
Thanks to you, Rene, and thanks to all the participants of today's webinar, which is actually the one that closes this season. So we're going to get back next October, and during summertime, we will issue our new program. Thank you again, Rene. Thanks, Paolo, Jaime, and all the participants. And wish you a pleasant, I don't know, morning, afternoon, evening, whatever you want, right?
All right.
Cheers.
All right.
Bye-bye.
Bye-bye, everyone. Bye,
Thank you very much.
Jaime.
Bye-bye.